If you want to earn double-digit rates of return by investing in stocks, growth stocks are one way that works. I've got 5 really interesting growth stocks for you in today's video. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. In today's videos, I'm going to look at 5 really interesting growth stocks, companies that have double-digit earnings growth expected going forward. And best of all, in the spirit of my namesake, Mr. Valuation, they can be bought at attractive valuations based on that growth. One of them is a superstar AI company that you really got to watch the end of the video till the end of the video to see. Anyway, let's go ahead and get started in 5 stocks investing for pure growth. The first stock I'm going to look at here is Plexus. And I'm going to use FastGraphs to illustrate the value of investing in these companies. And I started out here by just showing a picture of earnings. Plexus is a company that's in electronic manufacturing services. Now, one of the things I like to do with FastGraphs, I like to go into the external links and I like to go to a company's website and I like to look at what the company does. Okay, in Plexus, there's a really interesting video you can watch that tells you all about what the company does. You can also go into their About section, and this is where you can learn about these companies. But you'll find this to be a very interesting company. It has a market cap of $2.46 billion. You could call that a small cap or a small to mid cap. Only has 13% debt. It could be bought at a blended PE of 16.25, and that's below its historical growth rate of 17.77%. We're using a PE equals growth rate charts here. Now, one thing about stocks, where earnings go, especially when bought at valuation, price is sure to follow. And you can see that very clearly here that the stock price has followed earnings over time. There are periods of time, as always, when it gets overvalued, it comes back into fair value. When it gets undervalued, it comes back into fair value. The stock currently looks undervalued. Looking at forecasting, the stock is expected to grow at 14.89% going forward, a little slower than history, but still very attractive. Because it's trading at a slight premium to that growth rate, a PE of 16 versus the 15 PE, which is the orange line in this graph, that would mean you could look at making a double-digit rate of return investing in this stock going forward. Historically, Plexus has been a very great performer with no dividends. It's given you over a 10-bagger, turning 10,000 into 105,000 since October 4th, 2002. And that's compared to investing in the stock market or the S&P 500, which would have turned 10,000 into 46,000. So this is a very interesting stock today, and it's one that I think you can research further on your own and look for more attractive rates of return than you can get from traditional stocks. The next stock, and I've got these in order of estimated total return, is Fiserv. Fiserv is a payment processing company, and then once again, you can see how stock price has followed earnings over time. This stock went through a long period of time of being overvalued. That can happen, especially with growth stocks. And as you can see, it had double-digit growth all during this time. But once it got really high valued, I also want you to notice the importance of valuation. Even though the company did great, where it grew at 29%, 10%, 26%, 16%, investors actually would have lost money. They'd have turned $10,000 into $9,000 because they overpaid for the stock. The stock is now reasonably inexpensive, but it's close to being in value, and it started out just a little overvalued. So historically, this company would have turned 10,000 into 130,000 since January 3rd, 2003, again, compared to 46,000 in the S&P 500. So this is starting to look like a very attractive time to buy the stock. If you looked at it again at a 14% growth rate, you could earn about 11.13%. It might be worth waiting for it to get a little cheaper, just as we saw with our first candidate, Plexus. The next one is NSIT Enterprises, and we're going to take a look at NSIT Enterprises here. And once again, you see this strong correlation between stock price and earnings. This company's grown 11.64%. If you invested in it in 2003, you'd have turned 10,000 into 184,000. Forecasting wise, the company's expected to grow at just under 15% a year, And again, it's just a little bit above that 15 PE ratio to PE of 15.46, which would give you a 13.3% annualized rate of return. Once again, as with the other two, you might want to wait for a little better entry point. The stock was down yesterday. Today, it's trading down just a little bit again. So you might want to look for a little slightly better entry point for all of these selections here. But these are good growth stocks that you should put on your radar list now. The next stock we're going to look at is Allient. And Allient's a very interesting company. And once again, I want to remind you, you can go into the company's website directly from Fastgraphs. For those of you who are subscribers, you can go to their corporate website. And one of the things that is very interesting about this stock is you can go in here and learn a lot about it, including watching videos on the company that really teach you what they do. This company is all about motion. It's had a historical growth rate of over 17% a year. The market, because of that growth, has often applied a higher valuation. That's the market PE, or the average PE that the stock has traded at over this time frame. Performance-wise, it would have turned $10,000 into we'll call it almost $116,000 since January 2nd, 2004. Compared to like 42,000 in the stock market, or 45,000 in the stock market, and that includes dividend. This is the only one in the group that does pay and has paid a very small dividend, but dividend is really inconsequential here. It's less than a 1% yield. 490 million market cap. It's a small cap, has 50% debt, which is considered reasonable. The next stock we want to look at is Super Micro Computer. Now, this is the AI stock that I talked about. Now, the first thing I want to show you is historically, this stock would have turned 10,000 into 244,000 since July 6, 2007, where the market would only turn that into 27,000. This has a little shorter history than some of the other stocks that we looked at. I want you to notice that. But once again, you see the correlation between earnings and market price, how price follows earnings. But notice the explosion in earnings. This is the AI company I talked about. Earnings have exploded and are expected to continue to increase at a very high rate. Looking at the forecasting graph, this company is expected to grow earnings at 28%. Using Peter Lynch's P equals growth rate formula, if you were to buy this stock today, and the company did grow at 28% going forward, and it traded at a 28.46 PE, by June 30th, 2025, you would turn $10,000 into $22,896. That would be a 60% annualized rate of return. This is AI that could still be bought at a very attractive price. Anyway, this has been Chuck Carnevale, co-founder of Fastgraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. I wanted to show you 5 growth stocks here. I typically talk about dividend growth stocks, and I like dividend stocks for the conservative investors. But for those of you who like growth, or might even want to put a little growth in your portfolio to turbocharge, I think these are 5 ideas that could be very, very interesting, and that are all trading at relatively attractive valuations. They're not necessarily offered with a big margin of safety, because one of the attributes that you'll find over and over again with growth stocks is you often have to pay a premium for them. The AI stock is the only one that I think could really be bought dynamically below their growth rate. And it's one that's, one of the major players in AI, and you might want to take a look at that one very closely. I hope you enjoyed this video. I wanted to give you something a little different today. And if you like this video, give me a like, ring the bell, subscribe to the YouTube channel, but for goodness sake, subscribe to Fastgraphs, because I found these by going through our screening tool looking at growth stocks. And these are 5 stocks that I thought were very intriguing for the growth stock investor. Hope you enjoyed it. Talk to you real soon.